Well, for some time, we've been questioning what could change the trend in big tech and AI-related names. Well, it seems we've got our answers at the moment with hawkish rhetoric coming from both the Biden and Trump camp, and we've seen some very, very big moves in some of these stocks. But is this a short-term affair, or has this got further legs going forward? Now, most people had been expecting the Trump trades and the election trades to come through probably in September, maybe into October time. But we're seeing them right here, right now on the trading floors as we speak. We also have a look at what's happening in the pound, which is having a ripper at the moment. We've got cable trading around 130. We've got all-time highs in gold. We also have a look at some of the bank stocks. We look at volatility, as I say. It's all going on. This is the trade-off. Hi there, my name is Chris Weston, Head of Research here at Pepperstone. I'm going to join in 2 seconds by Blake Morrow from Forex Analytics. And we will be debating the big thematics playing through the market, mostly on the political side. We're seeing some decent moves coming through in the FX markets, and certainly client flow has been some very, very upbeat recently. Obviously, all-time highs coming through in the gold market, and they all need to be discussed. So I'm going to bring in my good friend, Mr. Blake Morrow. We are going to be very much on the political scene. I know I'm in Australia. I've got absolutely no skin in the game. But there's no way around it. We have to be able to price certainty. We have to price risk around it. And that's what we do as traders. So I am now fully entwined with policies, trying to understand the connections with markets. Will Biden actually run? It doesn't seem like he's going to now. In terms of the betting markets, we're not sure. How do we price risk around this event? But certainly, we've been spending a lot of time trying to understand the various politics, how that all could transcend into markets. How much of this is Trump doing what he does best as a real estate guy, bringing out the big guns and working it back on part of his negotiation tactics. I suspect that's a lot of what we're seeing. And then making those connections with financial markets and whether they're going to cause trends. But I'm guessing you've got to live and breathe the campaign, let alone be able to trade them, Blake.
Chris, what did we miss over this week? Did we miss anything exciting? I think we did.
I think we did. It's been pretty crazy, isn't it? Hang on to your hats.
It is a little crazy around the United States right now, and unfortunate event, obviously. But the one thing you pull away from it is that photo with President Trump holding his hand bloodied with the American flag behind him. That's probably one of the more iconic images that you're going to see floating around the United States.
Well, it's like World War II, isn't it? When the American soldiers are putting the flag in on top of the hill. Yeah, so.
They were the Marines, by the way, just so we're all clear. That's the Marines on Iwo Jima, and that's iconic for the Marine Corps. But some people say it's more iconic than that photo, and I'm like, I don't know, but I'm biased. I'm a Marine, so what can I say? But anyway, we are now starting to price in the reality that there is going to be a President Trump, and we're gonna be for a second term. So we're going to be talking about that here in a few minutes, because it is going to be very important.
It's going to get deafening, isn't it? But we do. Anyway, I want to go and let's talk straight about it. Let's go into the market pulse. Well, we can talk about the broader Trump trades in the next segment, but what we've been seeing now is real volatility, and you've got this double entendre. Biden, who's basically been talking about going after one of the Dutch, I can't remember the name now, one of the big tech companies that are supplying advanced chip technology to Taiwan. And saying, look, we might be going after them a little bit more. And obviously, Taiwan's a massive player. It is the player in the chip scene. It makes 90% of our advanced chips that mostly get sold back to US, IO names, and they're about 50% of the actual semiconductor chips out there. So they're obviously the player out there. So if you go after them, that has huge implications around AI. But then obviously you've got Donald Trump as well going, and talking about 60% tariff. There won't be 60% tariffs when we get there, but also, a whole raft of very hawkish rhetoric and protectionist rhetoric against China and other countries as well. Certainly Taiwan talking about insurance and them having to pay up for the protection. So really, you've seen massive moves coming out of tech. It's a very concentrated position. Everyone's been very long that place. There's some huge unwinds playing for a lot of that money going into banks, into energy, into healthcare. Banks banks are absolutely flying. JP Morgan, have a look at that chart. XLF, absolutely going nuts. So I think we've seen. Is this the thing that breaks the camel's back? And do we see a prolonged downdraft, or is there going to be a turning point in this? But how are you seeing the tech trade now?
Well, first of all, you don't have to look any further than the Philadelphia Semiconductor Index and the SOX, and that index has absolutely gotten blasted the last 24 to 48 hours, I guess you could say. Actually, just the last 24 hours, following that Bloomberg article, the Bloomberg Business Week article, with President Trump's interview, and he's really going after Taiwan, TSM. And matter of fact, TSM is putting a plant right in our backyard where I live, and it's really putting a lot of pressure on the tech trade. And I think people look at valuations too and realize that valuations are not quite there. But you said it, I think, without saying it, Chris. Rotation is still the name of the game right now. You are seeing look at the moves in JP Morgan, as you pointed out. United Healthcare ripping, Russell ripping. I mean, you're getting money flowing out of tech into other markets and other indexes, and so is the tech trade over? It might be, but I think if you're asking is the broad market, the stock market over, I don't know yet. And because if you turn it to like the next topic, when we talk about the Trump trade, what is the Trump trade and what are the predominant Trump trades? One of them would be, I think equities do find some support, especially as the market becomes more comfortable with the idea that President Trump is going to serve a second term, which I think is highly likely at this stage, but it's still a long 4 months, Chris. It's still long 4 or 5 months. Yeah, still a long time.
But we've got to remember that one of the big talking points. Now everyone's sort of thinking about about tariffs. There's no way in my mind that we're going to see 60% tariffs placed on Chinese imports. It would smash the Chinese economy. I mean, I think this is similar to what we saw in 2016, the rerun to 16, where pretty much every day you'd come in and Trump would talk very hawkishly towards Mexico. We'd see the dollar Mex would up 2% on the day. And then ultimately what we saw in 2020 was NAFTA was just renegotiated and actually came out very favourably for Mexico. So you start and you go really, really hard. You play your cards, you play your leverage, and then you walk it back to a much more reasonable level. So I'm sure the tariffs are going to be much lower than what's been pushed in. But I think from a market's perspective, one of the things for the equity markets is this promise that he's made for deregulating industries. Now those industries are going to be energy, they're going to be healthcare, they're going to be banks. They're the sectors which are firing up at the moment. So everyone's talking about tariffs, everyone's talking about deficit increases, which are going to be inflationary, but for me, regulation, I think, is one of the big kickers. And the sectors that really benefit from deregulation are the ones that are working at the moment.
Yeah, you're right. And going back to tariffs, and even in his interview, he's like 60%. I never said 60%. I did say 50%. And you're like, okay, that's still a big number. But, if you look around and you're like, okay, I look at some of the stock market plays, but what are the currency plays? If there are tariffs, significant tariffs put in place, that's gonna be a nice tailwind for the dollar moving forward. And you heard him in his interview. If you read the interview, he really talked about Japan, and he's really upset about the massive decline that we've seen in the yen over the last 4 years since he's left office. And he thinks that Japan's getting away with murder, so to speak. So between that and then you have the BOJ upcoming at the end of the month, the yen could really pick up some steam. So I think there's a lot going on in the Trump trade, and we're going to be talking about that. I have a feeling almost every week, or at least every other week, for the next several months.
But the problem with FX relative to the bond market, which obviously you're living 10 years ahead, is that the spot FX markets it's got so much other stuff to deal with between now and November. I mean, it has stuff to deal with in the next week or so. So putting on spot FX trades can be a very difficult situation. But obviously, one would expect as we get in there should be a nice trend higher in dollar Mex, dollar against the yuan would be an obvious one. But also, it's not just about the tariffs. I think the appointment of JD Vance has got a lot of people talking. I mean, the guy's got very, very, very strong views. But I think he's irrelevant. And why I say that, if you look at Mike Pence when he was Trump's running mate in 2016, he had really no influence whatsoever on markets. it was the Treasury Secretary that I think is going to be the most important role for the dollar, because Trump wants a weaker dollar, but it's going to be the Treasury Secretary who decides that. If you're going to get Robert Lighthizer, then you're going to get a weaker dollar, a big weaker dollar, because he wants to do the new Plaza Accord, but that requires other central banks to come in. They're talking about John Paulson or even Jamie Dimon. If you've got John Paulson, big hedge fund manager, or Jamie Dimon, that balances out JD Vance, because they're very measured, market-friendly heads. They know their stuff. And I think that would have a big influence on the dollar. But I think, if you're going to have tariffs, you're going to have lower immigration, which is inflationary. You're going to have tax rollovers, other measures. It's going to, I think you're going to see much higher longer term bond yields. That's going to be positive for the dollar. Let's just touch on volatility quickly, because we just want to skim through this one. We are seeing higher volatility. And for me, volatility begets volatility, because what happens, you've got so many of these players who they're set out equity allocations based on the volatility in the market, realised volatility. And as volatility is going higher, as people look to hedge out some of their downside now, that just means these volatility targeting funds are having to take cash out of the market. So volatility for me is now one of the most important aspects. People are starting to hedge that downside. That's paying up for downside protection. That's seeing the VIX higher. The NASDAQ VIX is now above 20%. Skew is pushing higher in favour of puts. So, how much are you watching the volatility scene here?
I am. Well, you remember last week, one of our setups was one of my setups was the VIX. It had a nice little triangle. It's up over 10%, and we get above 15%, and it's a trader's paradise for us. So volatility is big. But you know what else? And I know we just need to touch on this really quick. Bonds. I tell you, Chris. I know we're seeing the yield curve change quite a bit from the trend that we've seen. But more importantly, we're starting to see lower yields almost across the curve, and it's obviously bigger on the shorter end. But I think we're going to be due for some bond market volatility in the coming months, and also given the fact that CFTC positioning is so skewed to bond market shorts right now that we could see some short covering there. I know a lot of people are thinking that yields are going to continue to rise. I would take the other side of that trade.
Well, I think there's so much now being priced in that if you look at 2-year yields now just trading around above 440 or so, we've got the September rate cuts fully priced, 100%, and then you've got 60 odd basis points, two or three cuts being debated for the end of the year. We've got 190 basis points of cuts being priced over by 2 years, and I ask, 7.5 rate cuts being priced over 2 years. I can't see much more unless we're generally talking about a recession and they need to stimulate. So that takes us down to a neutral setting. If you believe we're going to get a recession, then we could get 10 cuts over that point. But so I think we've had a big adjustment. But I think in the front end we're certainly fully priced in terms of what we know now. It was going to take much more protracted downside in terms of consumption to take us below 4% in that situation. But never to say never, as Justin Bieber would say. But I think
you don't know what you don't know, Chris. No, you don't know what you don't know.
The big one, obviously, is if we get a red wave. Sorry, I'm going on, but if we get a red wave, so the Republicans take, the Trump in the White House, and we get both chambers of Congress going to the Republicans, then they have carte blanche really to go hard on the fiscal measures, and that's another $4 trillion on the deficit effectively over the next 10 years by the CBO's predictions, and that means much higher long-term bond yields, in my opinion, and so then you get the big curve steepeners that everyone really is wanting to see. Anyway, let's go to the charts that matter. It's a setup. Right, well, with longer-term with the bond market very much in play, let's have a look at the chart of gold, because our flows on gold have been very, very strong recently. As you'd imagine, when we see an all-time high coming through, 24.82, I think was the high that we saw yesterday. Number of factors that we can put out is you are seeing hedging against protectionist measures, about deterioration in relationships, potentially with a Trump presidency, which the betting market's putting at a 67% probability at the moment. We'll see who he actually runs against, whether it's Kamala Harris or Joe Biden. That's now an even chance. But also you've got this rate cut expectations, which has pulled down bond yields. We've seen real rates moving down, breaking down to about 189 on the 10-year real rate. That's boosted gold again. We've seen a re-establishment of positionings. EM central banks are buying. I know China's not, but certainly Zimbabwe have been coming out. All these fundamental factors have seen price moving up. People have been chasing it. Now, what we've seen is that firm breakout through that trading range. We've seen 24.50, 22.85, which has happened since mid-April. The question now, can it kick? It's looking frothy. I quite like this into 24.40, which is the 5-day exponential moving average. I'd expect to see a bit of a bounce from that point. But, if this does kick off, you find some buyers coming through as people start, seeing some fragility in terms of relationships, then I'll be chasing that, and I think we get 2,500. So it really depends. I like limit orders down into 24.40 for a hold above that 5-day. But if this does start to move higher, and I can feel that on the lower time frames, I'm chasing this one up in 2,500.
Chris, just one comment that I want to make here. Well, actually two. We're at 127% extension. That kind of top ticked us today. But a lot of Elliott wave Elliotticians that I follow, and whether you follow it or not, it's just the fact is I've seen a lot of them call that this move is the end of wave 5. So they're looking for a correction from here. I'm with you. I still think the trend is higher. Dips should be bought. But just a couple of things I wanted to note, just because I've been hearing it. That's it. Other than that. All right. So I want to take us over to the dollar yen. Matter of fact, the dollar yen's actually dropped about 70 pips since I put up this chart. We are down actually 80 pips from the New York close, and we're continuing lower. We saw massive divergence came out of an ascending wedge, and I think we're en route now to the 153.76 level, which is the 38% retracement of this last move. Then below that's 152, and that's where the rubber meets the road. That's the bull bear line that I'm looking at. But the yen's got a couple of things going for it. First of all, it's got president, or which could be former, could be second term President Trump, really looks to weigh on Japan, and I think maybe through rhetoric will weaken the dollar versus the yen, or strengthen the yen. Plus, you got the BOJ that has done some yen intervention over the course of the last week since the last time we talked, Chris. And then you got the BOJ at the end of the month. So I think it opens the door up to the 200-day moving average ultimately. But I think there's some downside left in this dollar yen over the course of the next week.
I love it. And do you know what? One of the best trades, you want to talk about one of the best trades for the election, is short MEX yen, and we've seen a massive move overnight. And if you think the yen's going to get a kicker because it's it will become an unwind of the carry trade, you're going to see a safe haven benefits along with the Swiss franc. If we were to see a higher volatility, the Mexican peso is going to be one that underperforms because of tariffs and protectionist measures. I think MEX yen, it's got some big downside going into the election. Obviously, it's a long time. We don't hold our positions that long, and you're going to be paying swaps on that one, which is expensive to hold for long periods of time. But I think from a capital perspective, I think between now and a couple of months, it could be markedly lower. Tactically, yes, that trade feels like it wants to go low. Whether it actually does is another thing. But if you're talking to me about Trump trades, I reckon MEX yen has some big downside potential playing through. But yeah, you're going to be paying up for holding those shorts. Let's go to cable. Let's go to sterling dollar. And I bring this up because it's obviously been ripping. It got into 130, above 130, and we saw the higher UK inflation numbers coming through yesterday. Core inflation in the UK is really quite problematic for the Bank of England. It's sticky. It's a word that gets thrown around about, but what we've been seeing is people looking to question now that August Bank of England meeting. It's now we've got 8 basis points. At one stage, it was almost seen as a fait accompli, and now essentially the market is now pared back some of that August bet. September's now seen as probably the more likely situation from a probability perspective, and there's been a move between UK rates relative to US, which has favoured being long the pound. But we've also seen momentum buyers push that up. So there's been a lot of tailwinds behind the pound more broadly. But now clients, if we have a look at our clients, we don't have a bigger position than in any other market than cable right now. And I think about 80% of clients are now short this one. So a lot of retail are really, really looking to pick, which you might get an 80% skew in, something like orange juice or, one of the sort of less traded pairs. But when you get a big, really well traded market, when you get a skew like that, you tell that retail are really looking at this one. But yeah, they're all short. I want to bring this up because there's so much momentum in this now. I like buying pullbacks, but I'd probably change that as if we get price closing below that 5-day exponential moving average, then I'd be also looking more at short opportunities. But then obviously, you need a stronger dollar, and that doesn't seem to be happening at the moment either.
Well, maybe my next setup or my last setup might play into that. So if you're a Pepperstone trader, which you should be if you're listening to the show, and you have the ability to be a Pepperstone trader, then maybe you should look at the pound New Zealand. Chris, this is the pound Kiwi. I was going to say a megaphone, but I couldn't really tie in Make America Great Again to the pound New Zealand. So I said just megaphone because it is a megaphone pattern. I was going to say megaphone, but just in light of everything. Anyway, we are at trend line resistance of the megaphone, 127% extension, and I think this is a really good pivot. Obviously, very overbought from a daily perspective, and you can clearly see where the upside breakout point is. So if you want to fade something, the Aussie Kiwi, the reversal that we saw on the New Zealand, weaker than expected. Inflation data totally just smells of positioning. So if you really think that Kiwi short positioning is maybe a little too hot and heavy right now, and you might think cable or pound bullish positioning is a little too bullish, maybe you get a little bit of correction here in the pound New Zealand, and then you can remove the dollar out of the equation. But anyway, I like the megaphone pattern. I like the resistance here at 215. As long as it's below 215, I think you might get a little corrective.
It was when Joe Biden spoke after the shooting, and I thought he spoke pretty well, actually, to be fair. But when he nearly came out with the biggest faux pas and said, when he was really close to saying "Make America Great Again," he managed to avoid just saying it, but it would have been a massive faux pas if it said that. Anyway, let's go to play of the day. I'm going to go for the Nikkei Japan 225. Now check this little highlight. Nikkei lower, I like that one. Yeah, I think this sort of plays. It plays into what we've been seeing in dollar yen. I think the Bank of Japan or the Ministry of Finance have been pretty snazzy. I mean, once they were literally hovering. They got the CPI print. They came out. They smacked the market. They caused dollar yen to rip lower, and they've done it again. On other occasions since that point, and the yen now has also benefited from a bit of an unwind of the carry trade. We've got the Trumps of this world talking about that, as you said in the Bloomberg article in the interview there, and so the yen is finding some love, and what that's impacting the equity market, not just from a hedging perspective for international investors who have bought into this and looked at their hedging exposures, but I think also from an export perspective as well. The stronger yen is going to impact their earnings as it did positively. But this is a kind of Nvidia of this world. We're going to be watching Tokyo Electron. But this has been a momentum beast, like all the tech trades. So when the tech trades are getting unwound, we're seeing the Nikkei underperform. So I think if we think dollar yen's going to be going down, if we think there's going to be some more fragility coming through in the tech trade, I see that really coming in and finding more downside in the Nikkei, the JPN 225. So any kind of rallies I think are going to be sold into, and I think you've got a decent downside playing through. So the trend, big liquidation. The market is very long. This market, dollar yen goes lower, and I think I want to sell a little bit of a rally into this. Just a little bit of heat coming out, bang, I'm in, and I think this goes lower.
Look, I love it when Wesley's playing the other side of Warren Buffett. He's got a lot of minions that got to get out.
Warren Buffett's killing it in his Japanese equity trades right now. Absolutely killing it.
He can give back some gains, and I think some of his minions will be hitting the bid, and Wesley's going to be right there selling it to him.
Warren Buffett was accumulating Japanese stocks last year. I mean, this is from April and May. So I think he's making a mozza.
Sure is. Well, hey guys, let me take you to my play of the day. And it's funny, our producer, he goes, "What does yours mean?" So Chris, what does yours mean?
Sell.
That's right. Goes when you're like, mine,
yours.
Yep. This is a trade. I've been looking for this since my week ahead video this week. So I'm going to play right into it on the trade off here because we got the ECB tomorrow. The dollar's been been pretty weak. We saw a key reversal in the dollar following the retail sales number. So I do expect a little bit of dollar weakness, but overall, Chris, I still like to own dollars. And in a Trump re-election, like for the next few months, I think the dollar is going to be the play. That's going to be the play that people are going to be looking to be long dollars, even if it's from a risk aversion standpoint, if it's from a tariff standpoint. I think the dollar is going to be bought. So I'm looking for a euro dollar short somewhere between 109.50 to 110. I think you clearly know where your risk is. It's this triangle that's very well defined. Look for a move back towards the 200 DMA, maybe even a little bit lower depending on how things evolve. But I am looking for a short in the euro dollar following the ECB meeting closer to 110.
Yeah, I think it plays into the rate story that I talked about, the fact that, we have got the rate setting, whether you're looking for September or going out to 2 years. I think the market's had a big adjustment and if we were to see some better data, the market could be very sensitive to that. Things move around so much in the rates market. We're perennially wrong in terms of market pricing. We get too many rate cuts that get priced out. We start talking about rate hikes to a degree. We then see the data deteriorate. Now we've got a situation where we've got nearly 2 or 3 rate cuts being priced in by the end of the year. Imagine we've got a really big payrolls. Imagine we've got a CPI number that's slightly hotter. People question that trade. Rate cuts come out the market. Dollar rallies. It's not a hard world to feel. You've got to be open minded to the trends. We've had so many swings and roundabouts and changes in the script when it comes to rate settings over the last 1 or 2 years that there's probably more twists and turns yet to come. The market has got hell bent on believing we're going to get this rate cutting cycle. It wouldn't surprise me whatsoever if we got a twist in this tail once again, Blake, and that caused the dollar to rally. So we're all data dependent now. We'll have to see the payrolls and some of the jobs numbers and obviously the CPI number. But that's it for the week this week. It's been a breathtaking week in financial markets. Tech's coming on well. We've got gold all-time highs. There's a lot of people questioning the sustainability of risk going forward because of this election. Everyone thought the election was going to the trades were going to take place later this year. We're certainly seeing some of those play out right here, right now. There's a lot going on in these markets. Thank you for joining us. Click the like button if you can and leave us a comment about what you're seeing on the markets. Cheers, Blake. Thank you, everyone.